My biggest lesson is not to overlearn lessons. The market's constantly changing. So any rules of thumb you have often turn out to be wrong. And if you keep using them, you're going to get into trouble.
Talk a little bit about what Night Watch is. Why was it created?
It's hard within the capital system where the analysts and PMs make their own decisions. So we wanted to come up with a way of creating a discussion forum for that would allow us to talk about tail risks and scenarios without forcing anyone to do anything.
It's hard to believe that the global financial crisis was 17 years ago now. What did you learn from those experiences that help you today?
Yeah, the first one was...
Today we have Julian Abdey with us. Julian has been at Capital Group for 22 years. He's a portfolio manager based in San Francisco. Thanks for being in LA today.
Pleasure. Thank you so much for having me.
So some people enter college and know exactly what they're going to do in life. I was not one of those people, by the way. But for you, I think you had your mindset on being an academic, and then all of a sudden you're a bank analyst. Those are super, super different, Julian. How did we get from A to Z or Z, depending on where you are in the world?
Sure. Well, I mean, I use economics every single day of my life in the job. So I keep using it and I still love it. When I was 16, my dad kind of nudged me to try A-level economics, and it was love at first sight. The first lesson, I'm like, this is what I need to do.
Which not everyone says.
No, I just knew it. So then I wanted to go to do economics at Cambridge and then do a PhD, work for the World Bank. And then while I was there, I spent a summer at a think tank and spent all the time running regressions. And I thought, maybe I don't want to do this for the next 5 years. And I'm so grateful I didn't go down the academic route. It's been wonderful though academics are. It's been a great career.
Well, you use it, like you said, all the time. It's just you're not doing it 24/7. So how'd you get interested in investing?
It's a good question. There's two stories I really remember from when I was younger. The first, my dad, hadn't gone to college, but was interested in the market. He gave me a book on investing, and I took the £500 I'd earned on the cashier and stacking shelves in the local supermarket and bought a company called Next PLC when it was kind of close to bankruptcy, and I was 16 or something like that, and it tripled my money in a year. And I thought, wow, this is a lot easier.
This is how it works.
This is a lot easier. The second really impactful moment was when the UK came out of the exchange rate mechanism, saw us, and Stan Druckenmiller broke the pound. And 2 years before, I'd written an essay at school saying, I think going back onto the exchange rate mechanism is similar to Churchill taking the pound back onto the gold standard pre-World War I. It'll result in economic problems and a forced monetary policy from Germany, and eventually the exchange rate will break. 2 years later, it did, and these guys made $1 billion. So I was like, I did not realize that was a job. So that got me super interested.
Well, they made that a really, really good job.
Really good job.
But between your 16-year-old 500-pound investment and looking at ERM, the exchange rate mechanism, you said, this is something I can and would want to do. Talk about investment edge. What do you think your investment edge is?
The first one is I really changed my mind. If the facts change, I will just move my portfolios and exit a position. I tried to not be embarrassed about changing my mind because we live with a great deal of uncertainty and managements change and policymakers change. The second thing I would say, I'm not a macro investor, and 80-90% of what I do is stock picking and using the analysts, which we have the most amazing analysts on in the business. But I am risk aware. I do think about what are the tail risks in my portfolio? Is my portfolio saying something about the world that I don't agree with? And then I try to tilt it so that it's more aligned with where I am. Most of the time, I don't have a macro view. Occasionally, I'll gain conviction and I will reflect it in my portfolios.
But that first part that you mentioned, that's a self-awareness, and it's also hard to say,
super hard.
I'm wrong.
Oh, yeah.
You're going in front of your investment colleagues who are friends and colleagues, but you're going and saying, I've had this thesis and I'm wrong at this stage and I want to change it for the following reasons.
Yeah.
Just how hard is that? It's a skill set that if you can really consistently apply, there's so much value in that. But how hard is it at that moment to sit at the table with 35, 45, 50 investment professionals and say, I know I've said to everyone I believe in this company and here's why we should all own it, and now I want to sell it?
Yeah, it's very hard, particularly as you're writing and talking on calls. So you just kind of got to step away and say, I don't really mind in the short term what people think about me. They may not like me in the short term, but if I'm right long term, doing the right thing for clients, it'll all take care of itself. And, look, you talked about my academic background. A lot of us were very successful academically, and that meant being right 95% of the time. So it's a big change to be wrong way more. Like, you're constantly basically getting C's the whole time. So that's a big psychological change.
Well, your 95 was my 88, so you beat me. So I'm going to do an abnormal thing for our podcast and do a hard pivot to what I took from your office.
Yep.
Because I'm like a kid in a candy shop. I can't wait. And it's sitting in here and it's staring at me, Julian.
Yeah.
I think this is Dr. Doom. Well, I know it is because on it says
It is Dr. Doom. It is Dr. Doom.
Show it to our camera and explain to the folks watching why you have Dr. Doom in your office in San Francisco.
Dr. Doom is a name that I picked up during the financial crisis. At the beginning of 07, early 06, late 06, I kind of started getting very, very negative on the financials. I was a bank analyst at the time. And it started out that people started saying, oh, here goes Dr. Doom again. Initially, it wasn't really something that people liked. But over time, they're like, what does Dr. Doom think now as things got progressively worse? So that was kind of the nickname I picked up. I'm not a perma bear, but at that point, I was very doomish.
Well, it was a good time to be doomish. I'm going to use that. I'm going to parlay that into the global financial crisis because there are moments in everyone's career where something happens and it becomes career defining. For you, it was the global financial crisis. You were Dr. Doom beforehand and saved our clients a lot of money by being that bearish at that time. How did that work? Tell us a little bit about your thought process. I think it was in 2007 where you wrote a piece, and you'll have a better title for it. I'll call it Sell Everything, but there was some other title for it. But how did you come to that thesis, and how did you know a year before every single front page of the newspaper was which company was going bust next? How were you a year early or 18 months early to that?
It's a really good question. There were so many stories from that time. That piece was called A Bank Analyst Nightmare, Credit Crunches and Scenario Analysis.
Okay, that's a longer title than Sell Everything.
Exactly. But it did say sell the banks, sell the mortgage companies, sell the capital market stocks. And that had come over a 6-7 month period that I'd kind of built confidence. And it was written in the middle of the night with jet lag in Germany after a small German lender had gone bust from US subprime. And I was like, this is everywhere. The contagion is spreading. So it started out 06. A large cap analyst, Des Schulte, brought in somebody who specialized in CDOs. And when I understood CDOs, it really got me worried. And we have this amazing...
So collateralized debt obligations.
Exactly.
Yep.
And then David Betanzas in our fixed income team also did those and really helped me understand how bad this could be. And once you started asking the question, what happens if house prices go down 10% nationally? It all flowed from that. So it was all about building confidence about, is that going to happen? Why will it happen? And what happens if it does? So I did a ton of reading. I was digging out obscure texts from the Great Depression, reading all of Bernanke's work, and I really, really built conviction. It really helped to have my fixed income colleagues and also my large cap bank analysts, particularly those from Asia who'd gone through these crises. And they said, yeah, this looks a lot like the Asian crisis to us. You're not that wrong. So I built confidence. But that moment in August was when I really felt true conviction. This terrible scenario is happening and it's playing out as I thought.
Well, you mentioned David Betanzas. And while our equity and fixed income folks work together all of the time, that was probably the time where it was so important for that to happen. You talked about the mortgage crisis. Talk a little bit about Fannie Mae
Yeah, that was one of the meetings that always sticks in my head. Martin Romo, who's our chief investment officer, was the analyst at the time, and we did own it at the time. We had this dinner with them, and again, I and we kept asking, what happens if house prices go down 10% nationally? Well, house prices never go down 10% nationally. I'm like, okay, what if they do? Well, they never do. This went on for about an hour, and eventually it became clear they didn't really have a plan if that happened. And it was kind of a wake-up moment to me.
Right.
And they said at a certain point, they said, well, if things get really bad, the Fed will come in and rescue them. And I looked at the CEO and I said, that's like Batman saying, don't worry, Superman's going to show up. You're Fannie Mae. So that really scared me in terms of the systemic issues in the system.
And then country-wise, when you look back to the GFC, the global financial crisis, there were a couple of countries that stood out that there weren't on the global stage per se. There weren't a lot of people talking about Greece and Iceland as far as the global economic system at that time. Is there an example of a country that also led you to the conclusion that maybe things aren't going so well?
Sure. Well, I covered U.S. banks and subprime companies and mortgage, but I also covered Europe, Middle East banks as well, small and mid caps. And so, it was very clear to me that the US was in trouble, but increasingly it was causing contagion elsewhere. The first one I remember being in the CFO's office at a small Greek bank, and they insisted they did not have any subprime mortgages in their bond portfolio. I'm like, you sure? They're like, no, it's all AAA or AA securities. I'm like, really? Could I just take a look at a couple of them? I looked at them, I was like, those are subprime mortgages.
And why didn't they know they were subprime
They didn't
mortgages?
understand the difference between a rating of AA, AAA, and what a subprime bond was. So you could have AA, AAA mortgages built on subprime mortgages, and they didn't really understand it. But I just saw the guy's face go white. I was like, oh my God, this is on a small Greek bank's balance sheet.
Right.
This is a problem. The other one was covered the Icelandic banks. At the time, the Icelandic banks were on a rampage, buying everything. They kind of become levered private equity funds. And they were super confident. They were buying companies and they were borrowing in the international markets. So I traveled there and I got a few warning signs. The first was the cab ride was like $200. And then I stayed in a hotel that wasn't very nice and cost more than a 5-star hotel in New York.
Big city, yeah.
Four Seasons. And then finally, the cab driver told me all of the ships coming into Iceland for the next 6 months were filled with luxury cars. All of that told me that the exchange rate was massively overvalued and you'd got all of this capital flowing in. These banks were multiples the size of the entire country. And again, a very simple question was, what happens if funding dries up and what happens if the exchange rate goes down? They kept insisting the exchange rate won't go down, the economy is so strong. But as soon as you understood that, the whole deck of cards collapsed. And all of this time was very difficult emotionally because I didn't want to be right. Because if I was,
magnitude of
if
how
I was
bad
right,
it would be. Right.
was terrible for our clients. It was terrible for people's jobs. People would lose their houses. Iceland basically went bankrupt. So it was, it wasn't one of those times where a lot of our analysts love getting things right and stocks going up. This was, I really didn't want to be right.
It's interesting. For some of us who've done this such a long time, it's hard to believe that the global financial crisis was 17 years ago now. But so what did you learn from those experiences that help you today?
Yeah. The first one was scenario analysis. I gained conviction because I had put all the scenarios out there in my head. And as the data came in, unfortunately, the worst scenario was playing out. So that was really critical. I also learned that, you don't have to trust CEOs and regulators and all these experts. Like, it's very easy as a young 34-year-old, and these very senior CEOs were saying, no, you don't understand. Actually, if you do your own research, you can have a differentiated edge and you don't have to believe them. And then I also learned just to change my mind when the facts changed and policies changed so that things were being dealt with. Then I changed my mind and got more positive.
We hear that from so many of our investment professionals about when the thesis changed, you have to change.
You have to change.
And people use that as a story they got right and got wrong. So we hear both of those, but that's the most important thing is challenge yourself. Has something changed? Through that period, we collectively at Capital Group created something called Night Watch. You were one of the founding members. Night Watch comes from Rembrandt. Behind you, you'll see the Night Watch painting. Talk a little bit about what Night Watch is. Why was it created? Help share what that is for us.
Well, to describe it, you have these soldiers looking in different directions for potential problems. It's hard within the capital system where the analysts and PMs make their own decisions, sometimes to see, connect the dots across multiple asset classes, multiple industries. So we wanted to come up with a way of creating a discussion forum for that would allow us to talk about tail risks and scenarios without forcing anyone to do anything.
COVID.
Yeah.
So share with us. So Night Watch, it gets when something like COVID happens, or more recently the tariffs, is that when Night Watch says this is our time to start linking together all of the variables out there?
That's exactly what happened. I was frankly dismissing it and got one of those calls. And so, my partner, Jared Franz, who's in our Capital Strategies Economics group, he and I partnered, brought in a bunch of healthcare analysts and PMs and started analyzing. This was in February.
February of 2020.
February of 2020. We hadn't had a single death in the US at the time. It was obviously spreading, but we hadn't had that. And we did the work and we worked with our analysts, and we kind of came up with three important factors. Firstly, the impact of COVID on the economy and society. Not necessarily how serious COVID was, but what it did to the economy. The second one was the fiscal and monetary response to COVID. And the third one was when would vaccines be available? So once we got all of those, it became very clear what the scenarios were. So it helped me as a PM, listening to these experts, to go from positive to very negative in February. But as soon as the Fed came in and as soon as the federal government started spending all that money, you had to get much more positive on asset prices, even while the economy was struggling. So it really helped my results. The most incredible thing I'll say is our farmer analysts, they thought there was a 70-80% chance of a vaccine within a year. And if we
Which at the time was
crazy.
Phenomenal outcome if that were ever to happen.
I think the last one, it took 5 years to get a vaccine. So that was really far out there. So that enabled me to think, and other PMs who listened to understand, I got to start shifting my portfolio away from work from home to work from office earlier than perhaps you would think. So it was an incredible collaborative process and really impacted how I worked.
Yeah. What I like so much about that story and the message is it is a period of time that's so easy to be so bearish.
Yeah.
We had closed the global economy for the first time ever.
Yes.
And so naturally, you get super bearish super quickly. And to say, well, what's happening with fiscal and monetary stimulus and what's happening with the vaccine and what can go right is a hard thing to do in that moment of time. But Night Watch helped that. And I'm guessing a whole bunch of investment folks joined on those calls.
That's right. Well, Eisenhower has a saying that plans are nothing and planning is everything. I think thinking these through things in advance enables you to move a lot quicker. I remember an analyst saying to me, you were really bearish last week and you're now bullish. It's like, the Fed is literally buying BBB bonds. Like, the asset prices aren't going to fall further. Like, we are done. And, it's inevitable if you print trillions of dollars of money, send people checks at a time where you have supply constraints, the prices will go up. So inflation was kind of an inevitable.
One of the stats I love from that time is you could get a 20-year Danish mortgage for zero. That seems very low.
Right. Exactly.
So yes, experimental monetary policy and fiscal stimulus can do lots of things for the economy and asset prices. Talking about analysts, because you mentioned that, during those periods of extreme volatility, what do you tell new analysts or newer analysts?
When COVID came along, having lived through the GFC, it was a time for me to reflect and say kind of what helped me. The first is focus on the research, focus on gaining conviction, get an investment edge, take your time to do that, communicate. I always had a rule to myself, the worse I felt on a day, the more I should communicate.
Don't hide.
Do not hide. Get out there. And building conviction is the most important thing. But fortunately, capital's a kind place. And I know when I was a young analyst, some of the senior PMs reached out and would check in with me. You doing okay? How's the stress levels? And that was really important to me. And just making sure that you're getting your health and mental and physical health taken care of. Otherwise, you can't make thoughtful decisions for our clients.
I want to switch gears and talk about, you invest in a lot of different parts of the market.
Yeah.
One of the ones you have invested in is small caps, and you've talked about why small caps are a great training ground for folks. Talk about small cap investing, which again it is a hard journey to be a small cap investor.
Yeah.
But talk about why that's a great training ground.
I love small cap, and it was the first fund, the first area that I was involved in as a small cap bank analyst. I'm a PM in a small cap mandate, and we think there's a couple of things. It's just you get more reps in. You see hundreds of companies. I would always see like 100 companies every single year. If you're large cap, you're probably meeting a far more
deeper dives into larger capitalized companies.
And you have to, a lot of these companies aren't covered by the sell side. You have to build your own models, really understand it, come up with your own ideas. So we've seen a lot of small cap analysts and PMs become large cap analysts and move on to other things.
But small caps today, if you look historically, they're super cheap relative to large caps. So why is that? Is that the two variables of small caps getting cheaper and large caps getting more expensive? Is that the concentration in the benchmarks? Why is that valuation gap so big right now?
It's a good question. So they're at 20-year relative lows versus the market.
Small caps are.
Small caps are versus large cap. There's a lot of factors going into that. The biggest one, of course, is the Mag 7 or Mag 8, however you want to talk about it. They've been such phenomenal stocks and they're so massive that it has created a disconnect. There's been more private equity involved, so some companies are going public later that may have previously been in small cap. And, we've had a sharp rise in interest rate, and some of those companies need funding. I'm feeling much better about the space right now. I think there's real opportunities. We're beginning to see some good IPOs at reasonable valuations. I think as AI diffuses through the economy and moves from a few big winners to actually being implemented, you could see some real acorns to oaks emerging from the small cap area that can leverage AI and become more efficient. And there'll be a lot of roadkill along the way as well. So I think we have some real opportunities there.
So you open the door to ideas. Share some. I mean, you're looking out 5-10 years. We have the benefit of time in our approach. What do you like? It could be sectors, it could be stocks, but talk to us about beyond small caps being cheap, which they certainly are to large caps. There being opportunities outside the U.S. relative to just the focus inside the U.S. What are some of your themes or specific ideas right now?
Sure. Well, one big theme we always have in small cap is what we call acorns to oaks, which is small companies that can become much bigger. And, that team, we owned Tesla and Netflix and Kotak Mahindra and TransDigm while they were still small cap. So we're always looking for those companies that become much, much bigger. But we have such a wide range of analysts that I'm finding opportunities all over the place. I'm particularly excited, actually, non-US right now. In Japan and Korea, you're seeing a real change in the culture towards being much more shareholder friendly. And it's having a dramatic effect. I used to have this phrase that you should never buy a cheap bank. There's nothing more expensive than a cheap bank. I've completely changed my mind on that. I own a couple of Korean banks that trade at between 0.3 and 0.6 of book value. They've got high single digits to low double digits ROEs. They're increasing their payout ratios. They're focused more on the shareholder. They're trying to get their ROE up. So
return on equity.
Return on equities, and they're buying back shares, and I hopefully get a valuation increase. And you kind of seen that play out in a lot of European banks that were trading there and have revalued up. And I think it's broadening and you're seeing it elsewhere. So I'm excited, and those are small cap, perfect for small cap.
You know, it's interesting. You talk about Japan and Korea, and I couldn't agree more what's happening in Japan and Korea in terms of a real focus on creating shareholder value. For the first time in 25, 30 years, if you're saying, is there a fundamental shift in the mindset of the managements of these companies? The answer is yes. People talk about India, people talk about Europe with having a European moment with potential significant fiscal stimulus coming out of the Trump tariffs. Do you have any specific views on Europe or India?
Well, India's been a great hunting ground for investments, both for small and large cap, and capital's been there from the very beginning that the market opened. And I think we have incredible research there. That country from economically continues to go from strength to strength, and certainly geopolitically, it's in the perfect position. Everybody wants to be friends with India right now. And I think some of the reforms that are going through are really helping the economy. So that's going to continue to be an area that we need to focus on. It's a little expensive, so some of that is already in the price. But I agree with you, finding great opportunities in Japan. Many of them have great engineering, but are surrounded by lazy balance sheets, conglomerate structures, and as new CEOs come in and change those, they can be incredible stocks. And I am excited about Europe. You know, it's been a terrible market for years, but I think what's going on is going to force change. It's going to force them to become more economically nimble. They're going to have to start spending. And a lot of these stocks are really cheap, and they're great companies. The engineering and the core business is really, really good. They've just had tailwinds. So as those tailwinds, the headwinds turns to tailwinds, there's going to be some really good opportunities there.
You're turning from fiscal repression to fiscal stimulus. That's just an amazing shift. You talked earlier about making mistakes. Everyone says the same thing, so I know there's too many to share, but I'm still going to ask you. What's a lesson learned?
Sure. My biggest lesson is not to overlearn lessons.
Say more.
What I mean by that is the market's constantly changing. So any rules of thumb you have often turn out to be wrong. And if you keep using them, you're going to get into trouble. The example I gave earlier of there's nothing more expensive than a cheap bank is no longer true. And I keep on my wall tchotchkes from First Republic and Silicon Valley. Those were two stocks that were fantastic stocks for me as an analyst. I did own some as a PM, and they went to zero in a week. So you got to constantly be updating your assumptions and thinking about where the world's going.
Maybe I should have picked this Silicon Valley tchotchke instead of Dr. Doom, but Dr. Doom was staring at me.
Exactly.
I didn't have a choice. Talk about mentors in your career.
Yeah, look, capital's an amazing place, and it was the company I really wanted to work for coming out of Stanford. And I was incredibly lucky to be hired by Jonathan Knowles, who's retired now. And he was a real leader in small cap, and I think one of our best investors. Nick Grace.
Legendary investor at Capital Group. Absolutely right.
Incredible investor. Nick Grace, he was a minings analyst. I think one of the best macro investors I've ever met. Incredibly bold. He will make incredibly strong statements in his portfolios, which I wish I could do. And then the final one is Brady Enright, one of our leaders. He started as small cap PM, and I really learned portfolio construction from him. He's passionate about meeting companies. He's always meeting companies, and just a real calm presence in times of problems.
Yeah. By the way, on Nick, so true in terms of conviction in the portfolio. It's a great lesson in having conviction. I'm going to get a little personal in our final segment here, Julian. So what some folks don't know is the most successful person in your family is actually your wife.
For sure.
So Sabrina Moyle, a successful children's book author. The company is Hello Lucky. And I didn't tell you I was going to do this,
thank you.
but on the screen behind you, for everyone listening, is a book called My Dad is Amazing.
Yeah.
Is this story about you?
It's about, she has this book. She has 35 books with her sister Eunice, who does the illustrations, amazing illustrator. There's also My Mom is Magical, which those are the big sellers. It's really about the love between a child and their parent, and trying to tell their parent that they're wonderful, but ending up saying you're amazing too. So my wife is an incredible talent. She is a shining light. She just launched a children's songbook to go along with her book. So she sings and she writes, and our house is full of joy and creativity. And I am humbled as a kind of nerdy economist to be married to her.
That's a wonderful thing to have and to say and to feel. I'm still going to ask you, though, to be grateful for something. So
Sure.
you used up your gratitude part. As I hand you your gratitude mug, and what can you obsessively be grateful for? I'll share that with you.
Sure.
But
Thank you.
My pleasure. But I'd love for you to share with our audience something that you're grateful for.
Yeah, look, I really do pinch myself every day. I come from a small town. My folks didn't go to college, and there were some tough times growing up, and I kind of can't believe how my life has turned out. I've had a great career with wonderful colleagues in a job I really love, and a wonderful wife that I adore and I'm crazy about, and 3 kids. It's amazing how things have turned out. Despite my moniker as Dr. Doom, I'm basically an optimist about the world,
Yes.
and things have worked out so great. So I'm very grateful about so many things.
Well, I remember, Julian, when you and I chatted, you were just headed out on a sabbatical, and I was saying to you, refresh, come back for the next leg of the journey. You've done that. We're so happy you're on this journey with us. You touched so many things at Capital Group, not just stocks, but so much of Capital Group, people and how we organize ourselves, and lots of different projects. And what I'll say about that is every single project you've touched, you've made better.
Thank you.
So thank you for being here and taking care of our clients. I have gratitude for that and for you being on this podcast. Thank you all for joining us. I hope you enjoyed it as much as I did, and we'll see you the next time around. Have a great day.